Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are in sunny Melbourne. The jackets are off, sleeves are rolled up. We're in a happier mood.
Sun's out, guns out, Andrew. That's what they say, mate. So yes, the weather is nice and shining in Melbourne today. I don't know if you can see that through the windows out the front there, but it doesn't
happen often here. So when it does, we need to celebrate it. We need to make sure that we make the most of it.
We're definitely going to enjoy the weather this weekend, and that's the good news about the new launch of the 360 Weather Podcast or Meteorology Podcast, right?
I'm surprised that you're not doing another shameless plug to someone to sponsor that part of the podcast.
The Bureau of Meteorology, potentially. I'm not sure. We'll wait and see. We'll get there eventually, Andrew. So before we get too far off track, what are we talking to our listeners and our viewers about today?
Yeah, so today we're talking about something that I think interests a lot of people. We get a bunch of questions around it, but it's how do I utilize my superannuation to buy property?
Sorry, did someone say property?
Yeah, exactly right. I think anything that's got property has a fair bit of traction with most people, and people tend to be really interested in it. So thought we'd jump on the podcast, talk about how do you use your super fund to buy property? What are some of the considerations that you need to take into account when you're doing so as well?
So the good, the bad, the ugly, deeper dive.
Yeah.
Yep. Why would you do it? Who should do it?
Yeah.
Who shouldn't do it? I think that's a really good topic, and let's get cracking. But Andrew, look, essentially, in order to buy property within superannuation, you need a self-managed superannuation fund.
Yeah. Exactly.
That's the basics of I guess the main differentiator, I guess in most people's mind between your ordinary superannuation fund, whether it be a wholesale or retail or an industry super fund versus a self-managed. Realistically, the predominant difference, there is more, but the predominant difference is it allows you to buy direct property, whether it be commercial or residential, inside your self-managed super fund.
Yeah, exactly right. And that comes with a few either intended or unintended consequences as a result. One of the benefits is that you can pull money together. So it doesn't just have to be your money. You can, pull money. Usually we're talking about a husband, wife, or a spouse. Yeah, family members that are purchasing property together. I mean, you probably wouldn't be doing it with someone that you don't have a pretty good relationship with and know that you're on the same page. But that's one of the benefits, is being able to sort of pull some of that money together to purchase one asset. In addition to that, there's a self-managed super fund is exactly what it sounds like. It's self-managed. So you've got significantly more control around the superannuation fund. But in addition to that, there's also a significantly larger amount of responsibility that's associated with it. There's more risk that's associated with it, and the costs associated with it are a lot higher as well. So, or generally speaking, can be higher as well. So, wouldn't be going into it lightly. You'd want to make sure that you're doing it with direction. I saw a pretty scary statistic, and this is old data, so please don't quote me on it, but they were talking about 1 in 6 superannuation funds or self-managed super funds in Australia were invested in cash. And we look at that and just say, why? I mean, I get it. If you want to invest in cash, that's fine. Like, you want to put money in a term deposit and that's your, risk appetite, by all means. But why go through the exercise and cost of a self-managed super fund when you can do the exact same thing in a retail or a wholesale?
And I think the key call out there, just to highlight that message, is complexity and cost. There's a significant amount of complexity and cost associated with establishing a self-managed super fund, as well as the continual running of a self-managed super fund as well too. So if the strategy calls for it and it makes sense, yes, do it. But you'd only do it, in our opinion, under particular circumstances if that investment strategy also takes into account the cost and complexity associated with it as well. And the example that you used is you wouldn't go to that level of complexity and incur all of those costs if you're just going to put it into, say, cash or fixed interest or whatever it may be. So specifically, I think for where we're going with this, we'll talk about it with a property lens, because if you want to buy property in superannuation, it has to be a self-managed super fund. I think where we've seen that number and that statistic come from, and it is old data, but I think the intent for people was to go into a self-managed super fund in order to get eventually to purchase property. And whether or not they got to the stage where they opened the fund, had it in cash, and then maybe they couldn't borrow the money, that may have been one thing, or they just ran out of steam or realized that there was a lot of complexity with it, and that's as far as it went. I'm not sure, but for the sake of the podcast, we're talking about property in particular inside self-managed.
Yeah, absolutely. And so I think when you're talking about property, one of the call outs associated with it as well is, obviously there's the cost of establishing a self-managed super fund, which we've already sort of touched on, but those costs will vary from, advice fees, an accountant to, set up the trust, set up a bare trust, assuming that there's some borrowings associated with it as well. But the other thing that you need to make sure that that you're fully aware of is that there's obviously stamp duty as well that's also associated with the purchase. So when you're purchasing assets in a regular retail industry wholesale super fund, you're not generally paying stamp duty on the purchase of those assets. So it can sometimes be a forgotten cost, and a very, very significant one as well. There are some additional duty costs as well when you're purchasing property through a trust. So you also need to take into account that, there's going to be a significant outlay. So it has to be a long-term strategy if this is ultimately what you're going to go down as well.
Yeah, and I guess, if you're talking property naturally leads towards a longer-term time frame. So a couple of things to consider. You touched on it briefly before, Andrew, when you were saying with a self-managed super fund, you can go into or create a self-managed super fund and have multiple members. One of the things to take into consideration, and it's usually not a big deal if it's a couple of partners, so spouses, but if you're doing it with other people, especially just because of the nature of property, thinking about what your exit strategy is. So in the event that, you've got this long-term time horizon saying, yes, the property in question, we plan to own it for 20 years. What happens in the event that one party wants out of that? You run into liquidity challenges because you can't sell half the property. We'll talk a little bit about that later down the track anyway, just in terms of liquidity and income and what the shape of that looks like. But that's a consideration to take into account when you are buying, I guess, property inside a self-managed super fund with other people as well too. That's a consideration that needs to be given a lot of thought to. And where it gets even more complex, as an example, if it was Andrew and I, because Andrew is a lot older than I am, maybe his time frame's different to mine, and he wants to exit that property, or he wants to convert that property into cash sooner than I do. How does his investment time horizon impact mine, and vice versa? So a little bit of complexity around it, and not that it's overly difficult to solve for once you know what that potential problem is in front of you. But with something that has a lot of complexity and a lot of cost, I think going into these things with all of the info on the table and your eyes wide open and planning out those what-if scenarios is a really good way of flushing those out to figure out whether or not ultimately what you're considering doing is the right decision and the right way to go.
Yeah, absolutely. And so you'd put, a few considerations around that, like what happens if someone, passes away or is permanently disabled or has a loss in income. You want to make sure that there's insurance policies that are going to cover that to be able to protect the other party. The other thing that you sort of touched on from a liquidity side of things is what happens when your strategy starts to deviate, particularly when there's an age difference between, two people that are purchasing a property. Someone's in retirement phase, they're drawing the income out. The other person's still in accumulation phase. They're wanting to focus on paying down debt. How do you manage that? How is that, if one person's paying down the debt, but the other person's pulling income out, then what happens is to the ownership of the property, you want to make sure that you've got all of that sorted
Yep.
before you go into it, because there's obviously a significant amount of cost in setting it up, but also in exiting that strategy as well.
And one of the other really prudent things to point out as well too is what can you actually do with the property? And I know that when SMSFs were first, I shouldn't say popular, but when purchasing property inside self-managed super funds were gaining a lot of traction, it'd be go and buy the beach house down at the beach with my super, and I'm going to go and stay there for a week while I'm doing some renovations and cleaning it up and bits and pieces and stuff like that. But we might talk around, I guess, the two significant different properties that we tend to see being purchased in SMSF, being the investment from a residential perspective, and then maybe we'll talk about probably a more used scenario or a more used case in terms of business owners and their premises. Andrew, you want to run us into that?
Yeah, absolutely. And so I think the key thing to note here is superannuation is utilized, or the rules around superannuation are for investment purposes in order to provide you a retirement income post ceasing work or post meeting a condition of release. So the very key and important note here is it must be an investment property. It cannot be used for any personal gain. It cannot be used for a house. It can't be used as a holiday house, even if, and some of the questions that we do get asked is, cool, I'll pay my superannuation fund rent. You can't. So if it's a residential property, it does not meet the arm's test rule, arm's length transaction. And so if it's a residential property and if you're using it for the purpose of personal enjoyment, even if you're paying for that personal enjoyment, and it's still satisfying the investment, you cannot use it for any personal use. The distinction becomes a little bit different when we're then talking about commercial property. So one of the strategies that we do see is business owners purchasing the property that their business operates out of, in which case the superannuation fund pays, the business pays rent to your superannuation fund. And that's a very popular and sometimes can be a hugely beneficial strategy from a tax side of things as well. And there is provisions in order to allow business owners to do that with their superannuation fund. So there is some complexity around it, and you do need to, obviously pay market rates. You can't, dial it up or dial it down depending on, maximizing your tax position or anything like that. It needs to be at market rates, but there are some limitations when it comes to owning property through a superannuation fund.
Yeah, and that's really a powerful strategy that we talk to business owners about all of the time, especially if you're a business where you're operating at a particular premises, whether it be office, commercial, industrial, you name it. But you kind of get the best of both worlds, because on the front of the business, you get to pay rent, which you would not ordinarily. So you're claiming the expense in your business. So on one hand, it's an outgoing on your business, but from your superannuation fund, you're actually in receipt of that rent as well too. So you're getting the benefit, I think, on both sides of the coin, which is the reason why it's such a powerful strategy that we see and that we talk to business owners about all of the time who fit the bill with that one. Just before we go on to, I guess, some of the benefits and the things that we see around tax and leveraging and growth, one of the things that is critically important in our mind that we talk to people about is diversification when it does come to property. And what I mean by that is if you've got a superannuation balance that you use in order to put down as a deposit for a property, roughly speaking, the bank will lend you 70%. So your loan to value ratio will be 70%. You'll need 30% in terms of your deposit, stamp duty, potentially GST if it's commercial, and some closing costs. So the money that you need in order to complete the transaction, you take that out of your super and you buy the premises or the property. The challenge then remains is, have you got any money left in your superannuation fund, or is it just the property itself? And if it's just the property itself, and going back to earlier podcasts and talking about the theory of diversification and not having all of your eggs in one basket, your entire retirement income strategy, your superannuation growth strategy, is determined on one asset class in one suburb in one premises. What else have you got growing alongside that in order to feed your retirement income or grow your retirement income down the track? So we're always cautious around how much money people use in order to buy a commercial property, but more so, the calculation is how much have they got left over and what level of diversification does that provide in their entire portfolio? Because it's very, very, attractive that you can purchase property. And if you get to your deposit amount, it's easy to just say, yep, I've got it. Here's a property. Fantastic. Without considering, hey, I'm actually liquidating my entire fund in order to go all in this one strategy, which is obviously against what we advise on. But that's probably a really big one that we see. So when we're talking to people and cautioning people around the strategy, what we really like to see is that there's money left over after the deposit and the closing costs are used, that there is enough money to have diversity and diversification within the portfolio for other assets other than just the property.
Yeah, and it is for a lot of people that are going down this route around purchasing property through their superannuation fund, it is a significant issue. We talk about the typical person that wants to enact this strategy is generally someone that owns the property that they live in. They might own one or two investment properties. They consider themselves property investors. And then all of a sudden it's, hey, I can purchase another property. How do I do it? I can utilize my superannuation fund to do it. And they just go forth and purchase another property. Now, not to say that that's going to, produce a worse or better outcome, but from a risk standpoint, it's significant. You're talking about every single asset that you own that's going to provide an income in the form of retirement income, all tied up within one asset class. If anything happens to that asset class, you're hamstrung. Like there's ultimately not much that you can do, particularly in an asset where there's such a significant amount of cost and time to move out of that asset. And so, if you even have the foresight to see something coming, to make an adjustment, by the time you actually list a property, sell a property, settlement happens, there is a huge amount of time. And so it can pose a fairly significant risk that you can't not consider.
Yeah. No, well said. So why do we do it? Why would we consider it? I think we put a pretty solid business case forward if you're a business owner, and just the power around being in control of your own destiny. And it's probably a bigger consideration, I think, if you're a particular type of business that has significant either setup costs, fit out costs, commissioning plant and equipment, where in order to pay off or absorb the cost of launching a new machine that weighs 30 tons, getting it set up, getting it commissioned, you don't want to have to move out of that premises that you're leasing that warehouse from, or whatever it may be, that factory, in 2 years' time, because you've doing that is just not practical. So I think from that perspective, it's really powerful for business owners because it gives them security around accommodation for their business. So I think that makes a lot of sense in that regard. Plus, above and beyond that, from our perspective, when we talk about different strategies with people around asset protection, the more assets that we can get outside of the business, it's always good for business owners, because we've seen it time and time again where people look at it and say, yep, my business is my everything. And touch wood, if anything ever happens to the business, all of that hard work and energy and effort disappears and there's no real wealth creation outside of that. So this is a really good mechanism to prevent that. So I get the commercial purchase aspect. But Andrew, what are some of the other things that we talk to people about around tax and leveraging and things like that around it?
Look, the obvious one is also leveraging. If you're talking about, say you've got a combined superannuation balance of 250 grand, and you decide to go down this route around a property investment, then you're not just subject to the market movements on 250 grand. You might be able to facilitate a property purchase, say 600 grand. So all of a sudden, if that $600,000 property increases by 10%, you've made 60 grand, assuming that there's no capital gains or costs or anything like that. Versus if your original $250,000 investment went up by 10%, you would only have 25 grand in profit associated with that. So the power of leveraging is one of the really big ones that people want to utilize when they're talking about it. Being mindful that it's also on the downside. It's not just on the upside. So increased opportunity, but also an increased risk associated with it. The other one, which I think is massively beneficial, provided that you can do it right, is
drum roll, please.
Drum roll when we're talking about saving tax, right? Let's say you've got the ability to purchase a property. It matches everything or it facilitates the entire strategy. You're going to purchase it. You're going to hold it for a significant period of time. You purchase it in accumulation phase. So while you're still working, while you're accumulating assets within your superannuation fund, you hold it for, let's say, 10 years, 15 years. It's got a massive capital gain that's associated with it. And so what some people will do is in retirement phase, so as they're starting to draw an income from their superannuation, they want to have a greater amount of liquid assets to be able to, buy and sell and pull money out and do all of that stuff. And so what you do is you sell it in pension phase. So you sell it in an environment where you're incurring zero capital gains tax.
Well, say that again.
You sell it at a 0% capital gains tax in an environment where you're paying no capital gains at the end of it. So you talk historically around what's been the biggest driver in terms of, property returns for most Australians. It's not in the rental income that you're receiving. The yields are relatively low. It's in the capital appreciation of the asset. And the biggest issue with accumulating, capital growth is that when you sell it, one, there's obviously a capital gains tax, but it's all of the capital gains is paid within one particular year. So you're automatically bumped up usually until your top marginal tax bracket. This affords you the ability to buy, hold an asset and sell it in pension phase where it incurs 0% in capital gains tax. And that's massive.
Yeah. I mean, look, there's no other structure that would allow us to do that.
Yeah, exactly.
It's as simple as that. So some planning around what this looks like for the right person or people, this is hugely advantageous in the right circumstances. And when you go and overlay that with the long-term time frame and being able to then eventually discharge and sell the asset, and we might talk about that in a sec as well too, but if you can do it and not pay any tax at the point of sale on capital gains tax, absolute massive. Yeah. It's huge. And if you consider, let's just do some really round numbers. You buy an asset worth $500,000. That's probably too low, but let's say you buy a property worth $500,000 and you've got it in your superannuation fund for 25 years before you hit pension phase. I don't know, maybe that 500,000 turns into 2 mil potentially over 25 years. You've made a $2 million capital gain that would be otherwise taxable. In this instance, sell it in pension phase and there's no tax.
Yeah. Versus a $2 million capital gain, even if you get a 50% discount. And so it's, $1 million in capital gain because you've held it for longer than a year. Let's say you own it personally. I'm just going to use a 50% tax bracket because you've just saved $500,000. Yep. It's a complete game changer. Yeah. And so for that reason, it can be incredibly powerful. Yep. And why there's such an allure to it. But what are some of the considerations that you really need to take into account to see if it is right for you, Bill?
Yeah, I mean, similar to what we were talking about in terms of the cash or the money inside your superannuation fund in order to be able to fund it initially. That's the first thing. The diversification, so making sure that you've got enough of a balance left over to still have money invested in other things other than that property within itself. But from a more practical sense, you need to make sure that the cash flow is continually there, especially if you've got borrowing against it. But if the cash flow needs to be there, most people would, but having the cash flow in order to support it. So realistically, if you've got a property, you're going to have some form of investment income in the name of rental income coming in to help support the borrowings. You're also going to have your super guarantee contribution if you are employed and receiving money from or receiving super from your employer. If you've got another member that's involved in the SMSF as well too, you'll have their SGC super guarantee contribution. And then above and beyond that, if you do have a diversified portfolio that sits in there, you should also be getting income off those other assets to be able to help and support that as well too. So I think cash flow is probably a big one to call out, that making sure that all of it still works on paper to make sure that you can continue to hold it for that long time frame to get to that 25 hypothetical year mark where we can then sell it for, CGT free, and then in that hypothetical save $500,000 in tax.
Yeah, exactly. And so one of the things with that, I mean, when you're talking about the cash flow piece, is do you need to make additional contributions to superannuation in order to be able to do it? And if you do, what level of contributions in order to also have a buffer in there as well? So you're talking about owning a property, you're talking about expenses and everything that comes along with it, in addition to the expenses of running a self-managed super fund as well. The borrowing costs are higher, so you're also paying more in terms of borrowing than what you otherwise would have. And so you really need to make sure that from a cash flow side of things, it stacks up. And if you need to make additional contributions, that's fine. But make sure that you've also got the cash flow to support the additional contributions. So if you're talking about a self-employed person that's opening up or wanting to purchase a factory or where their office works out of, in addition to, sometimes if you're self-employed, there's no obligation to make your own super contributions. And so does the business have, the ability to support the additional contributions into super as well?
Yeah, then from a cash flow perspective as well too, there's things like insurances. So not necessarily just insurance per se for the property itself. I'm talking things like more personal insurance, like your life insurance, income protection, which is usually held for a lot of people inside superannuation, just from a cash flow benefit perspective. So making sure that that you take those other fees and costs into account. If you are getting advice from an advisor, there might be some advice fees in there as well too. You've got your annual audit cost associated with the fund itself. You've also got your annual tax return requirements as well. So a few costs around just the other things on the peripheral of just the property itself. But Andrew, what's the alternative? What's the other alternative option? I mean, is this projected to give a better outcome? I think we've outlined the appeal of it, spoke a little bit about the complexity, the cost associated with it. But what's the alternative? What do we look at?
Look, the alternative is, your normal retail, wholesale or industry superannuation funds that most people have currently. Now, that may not be the best fund for them, or it may be the best fund for them, but comparing what the alternative situation will give you is the most important step in all of this. It becomes really easy to get wrapped up in the idea of, tax savings, having money in property, I get to control my money, and that's fantastic. But at the end of the day, what does the alternative option give you if, let's say, in the scenario of, you're going to purchase a $500,000 property using your superannuation, it's also going to cost you an out-of-pocket expense in addition to your normal super contributions of, let's say, 10 grand a year that you need to make in additional contributions. Well, what if I just retained my existing superannuation fund, contributed 10 grand a year into it? So you're equalizing, you're comparing apples with apples. What's the projected outcome of that versus the alternative? And so the step that is the most important, that is also probably the most forgotten, is do the numbers. Either, I would always say with a professional, so either a financial advisor, potentially your accountant, but do the numbers with a professional to work out what is scenario A going to be. Say scenario A is purchasing a property. What's the expected outcome in terms of how we're going to structure this? Is this, buy, hold, and have rental income? What level of rental income is going to give me in retirement? So work out the strategy around what you're trying to do. work out what scenario A is going to give you, and then work out what alternative option scenario B is going to give you. And essentially, you're going to have one option is going to be better than the other. It varies. And that's the thing that I really want to get out on this podcast is this is not everyone go down one particular strategy or another. It varies depending on the inputs. It varies depending on the income, on the value of the property, on the expected growth of the property, on the expected growth of your superannuation. It really varies. So just because you can do it and just because it works out from a cash flow side of things does not mean it's the best investment decision. And making sure that you're doing the numbers behind it is the most crucial step in all of this.
That sounds overly complicated, Andrew. And I think just to sum that up nicely, the easiest way to determine whether or not this is right for you, shameless plug, is to get advice. That's basically as simple as it is. And, you're going to need to get advice from somebody going through this. You'd need, especially with the way that the ATO are tightening up around opening self-managed super fund, and also from a lending perspective, the lending environment is getting tighter and tighter and more difficult as well too, where if you've got an advisor associated with the setup and the transaction, it's definitely a lot easier to navigate through all of that cost, complexity, and it'll prevent you from making a mistake as well too.
And shameless plug to our broker friends out there as well is, before you even go down the route of setting all of this up, make sure you've got your borrowing.
Can you borrow?
Can you actually facilitate the borrowing? Because last thing that you'd want to do is be one of those people that's gone through, the time, effort, energy, expense of setting all of this up. It's all there. It's all ready to go. And then the bank looks at it and says, there's no way you're borrowing for that amount of money, and it all falls apart. So get all of your ducks lined up before you execute.
Andrew, great episode. Well said, well summarised. I reckon we did that one a whole heap of value, and I'm looking forward to continuing the conversation and even starting to think about commercial property purchase for 360 Financial. That's obviously something that we've been talking about for a while, so just trying to find the right property. That obviously makes sense from our perspective as business owners. But thank you again for a great podcast.
Yeah, absolutely. Love it. Thanks, Bills. And thanks again to all of our listeners and our viewers. If you like that episode and you'd like to see more, please like, subscribe, and we look forward to catching you on the next one.
Cheers.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.